Chapter 14, Dividends, Retained Earnings, and Income Reporting. So dividends are basically just the distribution from the corporation of generally either cash or stock to shareholders on a pro rata basis. So basically, shareholders as owners getting a portion of the proceeds of the income for the corporation for the year. And pro rata basis just means that they receive whatever proportion of the income that's distributed. They get that on the basis of how much ownership they have of stock. Okay, so usually dividends are recorded on a quarterly or an annual basis as far as how much has been paid on a per share basis. We talked about the fact that they can come in officially 4 different forms, but we're only going to focus here on number 1 and 2, cash and stock. So don't even worry too much about property or scrip. So cash dividends first. 3 things that must exist for dividends to be paid. Without these 3 things, dividends cannot occur. They cannot be paid. So generally you have to have retained earnings. So there's usually state laws that say you cannot pay dividends out of paid-in capital. You have to pay them out of money that you've actually earned year to year in the company, which is reflected in retained earnings. In addition to that, retained earnings is just a book figure that shows you on the books how much you've earned for the year. But that doesn't necessarily mean that that's how much spare cash you have for the year. So you have to make sure that you're not cash poor. You have to make sure that there's adequate cash to cover whatever retained earnings that you're wanting to pay dividends out of. And then finally, once you establish numbers 1 and 2 there has to be a declaration of dividends, which is made by the board of directors. So accounting for these cash dividends. There's 3 important dates with respect to dividends that you need to pay attention to. One is the declaration date, which is when the board of directors declares a dividend. It's at that point that the company is actually obligated to pay, and so they record a liability. And then the record date just is the date when the company or the corporation establishes who all owns stock, and so who they're going to have to pay dividends to and how much they're going to pay to each person. And then finally, the payment date is obviously when the actual cash changes hands. So of those 3 dates, the declaration date and the payment date are the only 2 dates that require accounting entries. So this is an example of what happens on the declaration date. So if Corporation A declares $100,000 of dividends, you would make the following entry on the declaration date. You would do a debit to cash dividends for $100,000. This is basically where the money is going to be coming out of retained earnings. And then you're going to do a credit to dividends payable to show that you owe the stockholders that money now. Remember, until it's declared, you don't owe them any money, regardless of whether they have preferred shares or whatever kind of shares that they have. No dividends are required to be paid unless they're declared. At that point, once they're declared, they become a liability, and that's why you record a credit to dividends payable. So then, obviously, the record date happens. You decide who you're going to pay, and then you pay them. So on the payment date, you're going to debit that same liability account, dividends payable for $100,000, and that just shows that that account is now nets out to 0. And then you will credit cash, so that shows $100,000 leaving of corporate cash going back into the hands of the shareholders. So we talked a little bit about preferred stock and the difference between common and preferred stock. Remember that preferred takes preference over common stock anytime that there is any hierarchy in who's going to get paid. So when dividends are declared, preferred stock gets paid first. When the company is being liquidated and they pay their creditors, and then whatever money's left over goes to the owners, well, it does go to the owners, but it first goes to the preferred stock owners. Once they're paid in full, then anything that's left goes to the common stockholders. So they just receive that type of preferential treatment. If the preferred stock is listed as cumulative preferred stock, like you see in the second bullet point here, that means that any dividends that the stock entitles a stockholder to receive year by year that were never declared and paid keep building and building for the preferred stockholders. So every year that a dividend is not declared and paid for the amount that they have listed on their stock, that goes and is added together into this cumulative preferred stock account until finally, if dividends are declared, the corporation has to pay off all those back dividends that it kind of owed the preferred stockholders before it pays anything to common stockholders. So we also, in addition to cash dividends, have stock dividends. Some important things to recognize with the stock dividend is really no assets or liabilities are going up or down with this transaction. It's completely a transaction that's housed within the owner's equity section of the balance sheet and the basic accounting equation. Okay, so this is actually, in practice, what's happening here is retained earnings go down and paid-in capital goes up because you're issuing shares of stock to, and obviously these have a value, a cash value, and you're issuing shares of stock to shareholders. So basically what's happening is instead of paying the shareholders cash out of retained earnings, you're essentially buying stock with the retained earnings cash and giving it to the shareholders. So if you think of it that way, it's easy to see why retained earnings goes down, paid-in capital goes up. So here's an example. So let's assume that we have preferred stock that's par value of $10 per share, and start back again. I'm not talking about preferred stock here. We're looking at stock dividends. Let's assume that we have a stock dividend of 5% for 100,000 shares of $10 per share par value stock. So the par value of each of these shares is $10 per share. 100 shares means that's the amount that was authorized to sell of the corporation. And if we issue a stock dividend of 5%, that means of those 100,000 shares, we're going to distribute 5% of those to stockholders, current stockholders. So first of all, we need to change that 5% of 100,000 into an actual number of shares, and it's easy with this because it's 5,000 shares. Okay, so you have 5,000 shares valued at $10 per share, where the market value is $12 per share. Okay, so very similar to when we sell common stock to outsiders, instead of giving it to shareholders, you're going to debit, instead of cash, because you're not getting cash here, you're going to debit stock dividends, which is what represents the retained earnings going down. And then you're going to credit common stock dividends distributable for $50,000. And this is, what represents the par value of the stock that we're distributing, or that we've obligated ourselves to distribute. And then the amount that's greater than $50,000 of the value of that stock, that other $10,000, goes into paid-in capital in excess of par. So basically, as soon as we declare this dividend, we're immediately recognizing what the fair market value is as of the date that it's declared, and saying that we are changing $10,000 of retained earnings into paid-in capital in excess of par immediately. Okay, the other $50,000 we are obligating ourselves to change over, but we don't actually change it over into paid-in capital until the payment date. So this is kind of similar to a liability, but since it's a liability to itself, its own corporate shareholders, it's not considered a liability, but it functions the same way because this is an obligation that we're going to change some of our retained earnings over to paid-in capital. So you'll see that common stock dividends distributable has a credit balance now, and then in our next entry on the payment date, we're going to zero that out, which is what you see here, a debit to common stock dividends distributable for $50,000, and then a credit to common stock for $50,000. So at the end of the day, between these two entries, you have stock dividends for $60,000. That doesn't change. Okay, so that represents what's coming out of retained earnings. And then you have a credit to paid-in capital in excess of par of $10,000. That doesn't change. And then between this entry and this entry, you now have $50,000 common stock. Okay, so your paid-in capital account at the end of the day has $50,000 in common stock, and then that $10,000 in additional or paid-in capital in excess of par. Okay, and then obviously retained earnings goes down by that amount. So stock splits is very easy to account for because you don't have to do any accounting for it. In a 2-for-1 split, that basically means you take every share that's outstanding and you divide it into 2 shares. So if you used to own 1 share, now you own 2 shares, and instead of the value staying the same, you cut that value in half. So now the value of the stock that you have doesn't change because instead of owning 1 share for $10 that's worth $10, you own 2 shares that are worth $5. Okay. So all that really changes here is the number of shares outstanding because you're doubling the amount of shares out there, and then the par value you're cutting in half. But as far as bottom line changes, nothing really happens at this point. The idea is eventually the stock will start trading again more frequently because it's a lower cost, and eventually cost per share will get back up to around that same range when it was split. So at that point, shareholders have essentially doubled their money. Okay, so when we're talking about retained earnings, we've talked about what that is. It's a representation of basically operations over the years. So if those have been profitable, then you have whatever amount in retained earnings minus what you've paid out in dividends already. Okay, this doesn't necessarily equate to cash. It's basically a combination of assets that balances out to retained earnings. Okay. However, a company still could have negative retained earnings. So this would be any company that's maybe starting out and they're not making a profit for the first couple of years. They're going to have a deficit in the retained earnings account. So that deficit cannot be kind of netted out with the paid-in capital. Remember, for corporations, we have 2 sections of stockholders' equity, and they're not interchangeable. They're recorded separately for a reason. And one of them is paid-in capital, the other is retained earnings. Okay, so if retained earnings has a negative value, so be it. It has a deficit, so be it. At the end of the day, when you're figuring out total owner's equity, yes, you're going to net those 2 together, but you're still going to keep track of whatever your retained earnings are, even if they're negative. And there's several reasons for this. Some of these have to do with legal restrictions. So there are legal restrictions based on the state where you incorporate that determine what you can do with retained earnings, how you can use paid-in capital versus retained earnings for dividends. And like we talked about, rarely can you use anything but retained earnings to declare dividends out of. You may have taken out a loan where the requirements of the loan say, hey, in order to get this loan, you have to keep X amount of dollars in retained earnings year by year. Okay? Or you may have, the board of directors may decide it's in our best interest to keep $1 million of retained earnings every year, no matter what. Okay? So that would be a voluntary restriction. Usually, any types of these restrictions are recorded not in the financial statements themselves, but are usually in some type of footnote to the financial statements. So if once financial statements have been made, obviously once they've been distributed, they're kind of out there. You can't go back and edit and rechange financial statements that are already widely distributed and being used by consumers. So if there's an error that you find out after financial statements have already gone out, generally you kind of have to correct that error in whatever year you're currently working in. So if you find out that, hey, I had $200,000 that I didn't recognized as an expense, or $200,000 of expense that I recognize that I shouldn't have, like you see in this example, you go into the beginning balance of retained earnings for whatever period, whatever year you're in, and in this case, we're going to add $200,000, so a credit of $200,000 to retained earnings, and then we're going to we're going to debit accumulated depreciation, because last year or 2 years ago maybe, we had too much accumulated depreciation, so we had too much depreciation expense that year. So now we're going to get rid of some of that and roll back that money back into retained earnings. So, on the financial statements, you would show that going into retained earnings, and then there would probably be a footnote that disclosed the exact nature of the mistake. A retained earnings statement basically just shows changes, pluses and minuses to retained earnings for the year, how you get from the beginning balance to the ending balance. And in that second bullet point there, these are the general reasons why retained earnings would go up. And then in that third bullet point, these are the general reasons why you might see year to year a decrease in retained earnings. So return on common stockholders' equity is a ratio that investors and sometimes internal management looks at to determine maybe how a stock is performing, how a company is performing. It's a measure of profitability. And basically, you determine this amount by taking the total amount of money available to common stockholders for dividends and divide it by the total amount of money invested by common stockholders. So basically, you're going to look at however much money is in retained earnings minus anything that needs to be paid in dividends to preferred stockholders, and that's going to be your total amount available to common stockholders. And you're going to divide that by the total amount of money in paid-in capital common stock. Okay, so this is going to be all of the balances in common stock for the year. So usually you're just going to take an average of whatever the balance in common stock was at the beginning of the year and a balance of whatever was in common stock at the end of the year. You're going to add those two together and take the average of those, and that's going to be your bottom line number. So you divide that from that total amount of money from retained earnings minus preferred dividends, and that gives you your return on common stockholders' equity. This slide is basically just to show you that income tax is recognized as an expense, but it receives kind of special treatment on the income statement because it's a separate line item. Basically, you set it out separately because you have to determine all the other expenses and revenues before you can actually calculate income tax expense. So that's why it's not just lumped in there with the other expenses. Once you get the net income before taxes, then you can calculate income tax expense, then you subtract that, and you're left with net income at the end of the day. And down there at the bottom there, that's always just going to be the format. Once you've figured out what the income tax expense is for the year, you just plug that number into that formula there, and that would be your journal entry. Okay, so earnings per share is another kind of profitability metric that's used by shareholders or potential shareholders. So basically, again, you're taking, now this is just for 1 year at a time. So instead of looking at retained earnings, you're going to take net income for the year minus preferred dividends, and that will give you basically the net income that's kind of available to common stockholders. And then you're going to divide that by the weighted average of common shares outstanding, and that will give you earnings per share. And like I mentioned, you will not have to calculate weighted average of common shares. We're not going to go into that calculation. It's more advanced accounting. But just know if you saw a problem like that, that number would be given to you, and you would just have to plug in net income minus preferred dividends, divide it by that weighted average, and you would get earnings per share.